If Turkey were to sell the gold and buy Bitcoin, they would create two virtuous cycles. They would cause every other country to start selling their gold, and gold would get shredded down to 2 trillion, and Bitcoin would leap up to 25 trillion. They would also create an avalanche of other mid-sized and small countries buying Bitcoin. They would also create an avalanche of investors like the George Soroses of the world buying Bitcoin. Bitcoin would expand to be worth 10 trillion and then 100 trillion. Everyone that moves first ends up with a currency backed by Bitcoin. They actually solved the problem for all the people in the nation. They solved their own problem. They fixed the currency problem in the world. They can still keep the Lira. The Lira is now just backed by something much better. And they would save all the companies in Turkey as well and solve a whole set of other human misery issues.
Turkey's lira weakened as much as 3.3% to a record low on Friday, extending losses a day after the central bank's large rate hike failed to assure markets that President Tayyip Erdogan was abandoning his long-held unorthodox policies. The central bank raised its key rate by a hefty 650 basis points to 15% on Thursday, falling well short of expectations of a larger initial tightening that analysts said would have underlined a longer-term commitment to battle inflation. The central bank said it would go further in a timely and gradual manner after its first meeting under new Governor Hafez Gaye Erkan, whom Erdogan appointed after his election victory last month. New Finance Minister Mehmet Şimşek, who is highly regarded by financial markets, reinforced the U-turn message by saying the path towards price stability is going to be gradual but steadfast. Michael Saylor tweeted shortly after the lira's weakening, saying, "Imagine losing 8.5% of your wealth overnight. Try Bitcoin." According to Saylor, Turkey could easily get out of this problem by embracing Bitcoin and selling off its gold reserves. He also released another tweet saying that Bitcoin is winning the war against gold. Let us now get into the video and listen to Saylor as he discusses other economical advantages of adopting the Bitcoin standard. As you watch, don't hesitate to give us a like, subscribe, and drop your comments below.
The really big idea is the separation of property from the earth, or the digital transformation of property. There are hundreds of trillions of dollars of capital that are tied up in property like buildings and land. And if you look at the wealthy around the world, they store a lot of their wealth in property assets. And in an inflationary environment, when you're inflating the money supply by 7% a year, the only way to stay ahead of that is to have a balance sheet which is property heavy. I would say there's probably 3 drivers for Bitcoin's advancement. One is the digital transformation of property from physical property to digital property. The second is the conversion of corporate balance sheet from credit assets or debt assets, which are liabilities, to property assets, which are actually assets that are appreciating in value, like Bitcoin. And the third driver is the digital transformation of money, the ability to move money at the speed of light between a corporation and their customers or their partners, and that's the Lightning story. Mm-hmm. But let me just touch on each of them because I think they're equally important. They're very important ideas. One, if I have $1 billion building in London, and if the pound gets inflated by 7% in supply, then the currency I have loses 7% of its value between January 1st and the end of the year, the end of December. Now, I give you 2 companies. I give you a company that owns $1 billion of land in London, mm-hmm. or property, and I give you a company that has $1 billion of debt, of sovereign debt of the UK. Mm-hmm. On January 1st, if there's a 12% true inflation rate, the guy that owns the first company knows that his balance sheet's going to go up by 12%, and he's going to make 121 million pounds by the end of the year. The guy that owns the second company is going to get a 3% yield, and the debt is going to lose 12% of its value. And so the guy that owns the second company is going to lose, well, actually, they're going to accrete nominally by 3%, by 30 million pounds, but their assets won't be worth anymore. So there's a 90 million pound difference between a credit balance sheet or a debt-laden balance. As I say credit, you're owning credit of the UK government. So the person that owns the credit is 90 million pounds behind the person that owns the property. And if you just take it to the extreme, you just own the cash, well, your cash is worth 12% less at the end of the year. Your balance sheet of property is keeping track. So what you can see is that over the course of 10 years, companies that own property at that inflation rate are going to find their property value triples. And over the course of the same 10 years, the companies that just have the cash are going to have the same amount of cash, but it'll be worth 1/3 as much or something. So the companies that are operating companies that are required to hold cash or cash equivalents are being bled to death, and they're going to be bankrupted. And the companies that own property, the REITs, are going to keep up with the inflation. So the big idea here is twofold. One, you don't really want to own billion-dollar buildings in London. You want to own $1 billion of a digital building that has no property tax, that can move to any city in the world, that can be upgraded with technology, right? There's a cost to owning the real estate. It's also, you can only buy the $1 billion building with $1 billion of capital. But if you're a taxi cab driver in London, you want to acquire the building at £287 a month. You need to acquire incremental property. So digital property is better than physical property. And that means that you've got trillions and then tens of trillions and then hundreds of trillions of dollars of capital that should flow out of the buildings and the warehouses and the land into the Bitcoin network, because digital property is just better. Lower maintenance, lower tax. You can buy it and sell it in smaller portions. You don't need to be a rich family in London with an army of lawyers in order to buy Bitcoin.
Mm-hmm. Saylor, in one of his tweets, also pointed out that Bitcoin is a digital property. Saylor's tweet emphasizes the unique qualities of Bitcoin that contribute to its appeal as a store of value. Bitcoin's limited supply with a maximum of 21 million coins ensures scarcity, making it resistant to inflationary pressures. The decentralized nature of the cryptocurrency, free from the control of any central authority, adds to its attractiveness as a hedge against economic uncertainties and geopolitical risks. With the ongoing concerns of inflation and the erosion of fiat currency's purchasing power, Bitcoin offers a potential safeguard for individuals and institutions seeking to preserve their wealth. As traditional forms of investment may be subject to inflationary pressures, Bitcoin's decentralized and deflationary nature presents an alternative option that can potentially preserve value over the long term. Let us now get back to the video.
Every company on earth that's required to hold its balance sheet in cash or cash equivalents is being bled 7 to 14% a year by monetary inflation. And that's why all the companies fail. And that's why if you're going to be an entrepreneur and you want to be around in 100 years, you need a property company with your assets have to be property. They cannot be credit and they cannot be cash. And if you're trying to actually make money by doing something, like I'm a restaurant or I'm a hotel, the doing of something gets exponentially harder. When the true inflation rate is 12%, you have to grow your cash flows by 12% in the UK this year in order to stand still. So statistically, 99% of companies cannot grow their cash flows 12% a year. In a competitive market, if you don't have a monopoly, it's probably almost impossible for you to do that 5 years in a row. So when the political system creates a highly inflationary currency, if your business model is to have no capital as property and be capital weak, or to hold credit as capital or cash as capital, then you have to literally grow your cash flows faster than the inflation rate. And that's why there's a 99% mortality rate on companies. That's what's destroying hundreds of thousands and millions of small businesses. And that's what causes monopolies to form in every sector in the world. It's because of the monetary policy of the government. You have to have an endowment, and the endowment has to hold non-cash instruments. Like if Oxford or Cambridge or if Harvard University or Yale, if they had an endowment that had cash, they would all be out of business. So the endowment has to have property type investments. And of course, the solution to all this is all those institutions. If you want your institution to last 500 years, whether it's your family, or whether it's your church, or whether it's your university, or whether it's your country, or your city, or your government, you just endow it with Bitcoin, right? Because Bitcoin is the apex property. It will appreciate at a faster rate than the currency will debase, and it has a lower maintenance cost than all the other property assets, and it's globally more scarce, more desirable. So there is a solution, but most institutions live in fear. They're either stuck in a fear, what is the word, like a doom loop, or they're stuck in a traditional view, which is the bank is not allowed to have Bitcoin because it's against the regulator's rules. The endowment is afraid to buy Bitcoin because they're afraid they'll be criticized by it. The company doesn't want to own Bitcoin because of GAAP accounting, and that penalizes them. So they're either afraid of something new, or they're afraid of the volatility, or the accounting is prejudicial, or their charter doesn't allow them to do it, or they don't know how to buy it because they can't find a custodian or a trader they can trust. So in the early stage, it's a challenge for them to discover this, and that's why education and advocacy is so important right now. But Bitcoin does represent the solution to the problem that ails the civilization right now.
Crypto exchange Coinbase has lost market share in the booming Ether staking business as mounting pressure from U.S. regulators weighs on its staking service. The exchange's share in Ether staking slipped to 9.7%, the lowest level since May 2021, according to a Dune Analytics chart by digital asset investment product issuer 21 Shares. This is a significant drop from the 13.6% recorded on April 12, when Ether's Shanghai upgrade allowed withdrawals for the first time. The downturn has happened as the demand for Ether staking, locking up tokens to participate in securing the blockchain while earning a passive income on holdings, was soaring. The Shanghai upgrade unleashed a wave of deposits to staking, with inflows outpacing withdrawals by some 3.5 million Ether, worth $7.3 billion at current prices. Coinbase, however, suffered a net outflow of $517 million, 272,315 Ether, during the same period, the second largest amount after rival crypto exchange Kraken. A potential reason could be that investors do not want to be exposed to regulatory risk by using Coinbase staking services, Tom Wallin, an analyst at 21 Shares, told CoinDesk in a note. Kraken was sued by the U.S. Securities and Exchange Commission, SEC, earlier this year and shuttered its staking service for U.S. customers as part of a settlement with the agency. On June 6, the SEC also filed a lawsuit against Coinbase for violating federal securities laws, including offering unregistered securities to users with its staking service. However, the exchange said it remained committed to keeping its staking service. Since the lawsuit, Coinbase has withdrawn some 149,300 Ether from Ether Proof-of-Stake network, while depositing only 52,992 tokens, blockchain data compiled by 21 Shares shows. The $183 million net outflow indicates that users were unstaking tokens and fleeing the exchange. Coinbase still held its position as the second largest staking service provider, but fast-growing rivals such as Figment, Rocket Pool, and Kiln have been closing the gap, a Dune chart shows. The exchange takes a 25% commission on user rewards earned by staking, so a decrease in the amount of staked tokens means less revenue. Can you think Coinbase and cryptocurrency will come out of the SEC grasp unscathed? Feel free to share your opinions in the comment section below. Also, don't forget to like, subscribe, and turn on notifications. Thanks for watching.